Are you navigating the volatile world of Bitcoin and looking for the right investment strategy? Whether you're riding the bull market or bracing for a bear, understanding how to use Bitcoin ETFs like BITI and BTF can make all the difference in your portfolio. In today's video, we're diving deep into how these two ETFs work, the risks and rewards they offer, and how you can strategically position them to maximize your gains and protect your investments. Let's get started. How do BITI's inverse performance metrics compare to BTF's direct performance metrics over the past year? BITI, ProShares Short Bitcoin Strategy ETF, and BTF, Valkyrie Bitcoin Strategy ETF, offer different approaches to Bitcoin exposure, with BITI providing inverse performance to Bitcoin's price and BTF offering direct exposure. Understanding how BITI's inverse performance metrics compare to BTF's direct performance metrics over the past year requires analyzing their performance against the price of Bitcoin. 1. BITI's inverse nature. BITI is designed to deliver the inverse, opposite, of the daily performance of the S&P CME Bitcoin Futures Index. This means that when Bitcoin's price falls, BITI is expected to rise by approximately the same percentage, and when Bitcoin's price rises, BITI should decline by a similar percentage. Therefore, BITI acts as a hedging tool for those expecting a decline in Bitcoin prices. 2. BTF's direct exposure. BTF, on the other hand, is designed to offer direct exposure to Bitcoin through futures contracts. It seeks to reflect the performance of Bitcoin by investing in Bitcoin futures, so when Bitcoin's price rises, BTF's value is expected to increase, and when Bitcoin's price falls, BTF's value is expected to decrease. 3. Performance comparison over the past year. Over the past year, the price of Bitcoin has experienced volatility, with periods of significant price increases and declines. BITI's performance would inversely mirror these movements, so during periods when Bitcoin's price dropped, BITI would have seen positive returns, and vice versa. BTF would have shown positive performance metrics during Bitcoin price increases and negative performance metrics during declines. If Bitcoin's price increased over the year, BTF would have outperformed BITI, as BTF benefits from rising Bitcoin prices, while BITI would have underperformed due to its inverse relationship. Conversely, if Bitcoin's price decreased over the year, BITI would have outperformed BTF, delivering positive returns as Bitcoin fell, while BTF would have incurred losses. 4. Volatility and daily resetting. Both ETFs are affected by the daily resetting of their positions, meaning their performance can deviate from a simple inverse or direct percentage over longer periods due to compounding effects, especially in a volatile market. This effect is more pronounced in BITI due to its inverse structure, which can result in greater deviations from the expected performance over time. In summary, BITI's inverse performance metrics over the past year would have been opposite to the performance of BTF's direct metrics, with the actual comparison depending on Bitcoin's price trajectory over that period. If Bitcoin's price rose, BTF would have had positive metrics and BITI negative metrics. If Bitcoin's price fell, BITI would have had positive metrics and BTF negative metrics. The impact of volatility and daily resetting also plays a significant role in the actual returns experienced by investors in these ETFs over time. What are the implications of holding BITI versus BTF in a portfolio over a long period, considering compounding effects? When considering holding the ProShares Short Bitcoin Strategy ETF, BITI, versus the Valkyrie Bitcoin Strategy ETF, BTF, in a portfolio over a long period, several implications arise due to the nature of these ETFs and the impact of compounding effects. 1. Nature of the ETFs. BITI is designed to provide inverse exposure to Bitcoin's daily performance, meaning it seeks to deliver the opposite of the daily return of an index tracking Bitcoin futures. BTF, on the other hand, is designed to provide direct exposure to Bitcoin by tracking Bitcoin futures contracts. This fundamental difference means that BITI and BTF will generally perform in opposite directions on any given day, depending on the movement of Bitcoin's price. 2. Impact of compounding. Compounding refers to the process by which investment returns are accumulated over time, and it has different implications for BITI and BTF due to their structures. For BTF, as a direct exposure ETF, the performance of BTF over time should closely follow the cumulative performance of Bitcoin futures. If Bitcoin's price increases steadily over time, BTF will accumulate gains, benefiting from positive compounding. Conversely, if Bitcoin's price decreases over time, BTF will experience losses, with those losses compounding over time. The compounding effect for BTF is relatively straightforward and closely tied to Bitcoin's overall performance. For BITI, BITI's inverse structure means it is designed to move in the opposite direction of Bitcoin's daily performance. Over a single day, this relationship is clear. However, over multiple days, compounding can significantly affect returns. If Bitcoin experiences volatility, with frequent ups and downs, the compounding of BITI's daily inverse returns can lead to a performance that deviates from simply being the inverse of the cumulative return of Bitcoin. This is because compounding in an inverse ETF like BITI can amplify losses or gains in unpredictable ways, especially during periods of high volatility. For example, even if Bitcoin ends a period with little overall change, the compounded daily losses and gains in BITI can result in a net loss. 3. Long-term holding implications. Holding BTF long-term. Since BTF directly tracks Bitcoin futures, its performance over the long term should generally reflect Bitcoin's price movement, with compounding positively or negatively affecting returns based on the direction of Bitcoin's trend. If an investor is bullish on Bitcoin over the long term, holding BTF could result in gains that compound over time, assuming Bitcoin appreciates. However, if Bitcoin declines, BTF would similarly compound those losses. Holding BITI long term. Holding BITI over the long term is riskier due to its inverse nature and the effects of daily resetting and compounding. BITI is designed for short-term trading and hedging purposes, not long-term investment. Over extended periods, the compounding of daily inverse returns can lead to significant underperformance relative to what one might expect if they assume a simple inverse of Bitcoin's performance. In a volatile market, even if Bitcoin trends downward over time, BITI might not deliver proportional gains due to the eroding effects of compounding. If Bitcoin fluctuates, but ends up near its starting value, BITI could still incur significant losses. 4. Volatility's role. Volatility exacerbates the compounding effects for both ETFs, but it particularly impacts BITI due to its inverse structure. For BTF, volatility means more fluctuations in value, but the overall trend of Bitcoin will still primarily determine the outcome over the long term. For BITI, however, volatility can lead to the compounding of negative returns, even in a sideways or mildly downtrending Bitcoin market. 5. Portfolio implications. Incorporating BITI or BTF into a portfolio has different strategic implications. BTF in a portfolio. BTF can be used to gain exposure to Bitcoin's price movements. If an investor believes in the long-term appreciation of Bitcoin, BTF can be a useful tool. However, its inclusion increases the portfolio's risk due to Bitcoin's inherent volatility. BITI in a portfolio. BITI might be used for hedging or for short-term trades to profit from anticipated declines in Bitcoin's price. Holding BITI long-term, however, is generally not advisable because of the negative impact of compounding over time. Its long-term inclusion could lead to unexpected losses and increased portfolio volatility. In summary, the implications of holding BITI versus BTF over a long period are largely shaped by the compounding effects and the inherent design of each ETF. BTF aligns with the long-term performance of Bitcoin, making it suitable for investors with a bullish view on Bitcoin over time, despite the associated volatility. BITI, due to its inverse and daily reset nature, is typically unsuitable for long-term holding, as compounding can lead to significant underperformance or losses, even if Bitcoin's price declines over time. How do the fees for managing futures contracts differ between BITI and BTF, and how might these fees affect the net asset value, NAV, of each ETF? The fees associated with managing futures contracts for the ProShares Short Bitcoin Strategy ETF, BITI, and the Valkyrie Bitcoin Strategy ETF, BTF, play a crucial role in how each ETF's net asset value, NAV, is affected over time. Understanding the structure and implications of these fees is essential for investors considering these ETFs. 1. Management fees. BTF, Valkyrie Bitcoin Strategy ETF, BTF charges a management fee for the service of providing exposure to Bitcoin through futures contracts. This fee typically includes the costs associated with managing the fund, such as administrative costs, custodial fees, and other expenses required to maintain the ETF. Management fees are charged as a percentage of the fund's assets under management, AUM, and are reflected in the ETF's expense ratio. For BTF, this fee is intended to cover the operational costs of continuously rolling over futures contracts to maintain the desired exposure to Bitcoin. BITI, ProShares Short Bitcoin Strategy ETF BITI also charges a management fee, which covers the expenses of maintaining its inverse exposure to Bitcoin. This fee is generally comparable to other ETFs, but may differ slightly due to the complexities involved in managing a fund that seeks to deliver the inverse performance of an index. Like BTF, BITI's management fee is expressed as an expense ratio and is deducted from the ETF's assets, which impacts the overall returns to investors. 2. Futures contract costs. BTF, since BTF invests directly in Bitcoin futures, it incurs costs related to the rolling of these contracts. Bitcoin futures contracts have expiration dates, meaning the fund must regularly sell expiring contracts and purchase new ones to maintain exposure. This process, known as rolling, can involve additional costs, particularly if there is a significant difference in price between the expiring and new contracts, a phenomenon known as contango. In a contango market, where future prices are higher than spot prices, rolling contracts can result in a cost to the fund, which is ultimately reflected in the NAV. BITI also incurs costs associated with managing its inverse futures contracts. Similar to BTF, BITI must roll futures contracts to maintain its position. However, because BITI seeks to deliver the inverse performance, the mechanics can be more complex. The fund might need to engage in various derivatives or strategies to achieve the desired inverse exposure. The costs associated with these strategies, along with any contango or backwardation, where futures prices are lower than spot prices, in the futures market, can also impact the NAV of BITI. 3. Impact on NAV. For BTF, the management fees and costs associated with rolling futures contracts are subtracted from the ETF's assets, directly impacting the NAV. Over time, if the costs of rolling futures are high due to a contango market, the NAV could be eroded, even if the underlying price of Bitcoin remains stable or increases. This means that the performance of BTF might slightly underperform the actual performance of Bitcoin due to these ongoing costs. The expense ratio directly lowers the returns to investors because it is deducted from the NAV. For BITI, similar to BTF, the fees associated with managing BITI, including the costs of rolling futures and other strategies required to maintain inverse exposure, are also subtracted from the fund's assets, affecting the NAV. Because BITI is designed to deliver the inverse of Bitcoin's daily performance, the combination of daily compounding and ongoing fees can have a compounded negative effect on the NAV over time, especially in volatile markets. Even in a declining Bitcoin market, where BITI is expected to perform well, these fees can reduce the overall returns investors might expect. If the futures market is in contango, the cost of maintaining short positions can further erode the NAV. 4. Long-term implications. BTF, over the long term, the fees associated with managing futures contracts, combined with the potential for rolling costs in a contango market, mean that BTF might underperform the spot price of Bitcoin. Investors should be aware that while BTF is intended to track Bitcoin's performance, these fees will consistently reduce the NAV relative to the direct price of Bitcoin. BITS. For BITI, the long-term implications of management fees are even more pronounced due to the inverse nature of the ETF. The daily resetting of positions, combined with management fees and the costs of maintaining inverse exposure, can lead to a significant reduction in the NAV over time. Investors using BITI as a long-term hedge might find that the actual performance diverges significantly from the expected inverse performance of Bitcoin, primarily due to the erosive effect of these fees. In summary, both BITI and BTF incur management fees that affect their NAVs, with the costs of rolling futures contracts and maintaining their respective strategies being crucial factors. For BTF, these fees can lead to a slight underperformance relative to Bitcoin spot price, while for BITI, the combination of fees, compounding effects, and the complexities of maintaining inverse exposure can lead to a more significant erosion of NAV over time, making long-term holdings particularly challenging. What are the potential consequences of contango and backwardation on the performance of BITI and BTF? Contango and backwardation are important concepts that significantly impact the performance of ETFs like the ProShares Short Bitcoin Strategy ETF, BITI, and the Valkyrie Bitcoin Strategy ETF, BTF, both of which utilize futures contracts to achieve their investment objectives. Understanding how these market conditions affect each ETF can provide insight into their potential performance and risks. 1. Contango. Definition: contango occurs when the futures prices for a commodity, such as Bitcoin, are higher than the spot price or the current market price of the commodity. This typically means that the longer the duration of the futures contract, the higher the price will be compared to the spot price. Impact on BTF. For BTF, which is designed to provide direct exposure to Bitcoin futures, contango can negatively affect performance. When the fund rolls over its futures contracts, i.e., sells contracts nearing expiration and buys longer-dated ones, it will have to purchase the new contracts at a higher price due to the contango. This means that the cost of maintaining exposure to Bitcoin futures is higher than the actual spot price of Bitcoin, leading to a loss during the rollover process. Over time, if the market remains in contango, these rollover losses can accumulate, potentially resulting in underperformance relative to the spot price of Bitcoin. Impact on BITI. BITI seeks to deliver the inverse of Bitcoin's daily performance by using futures contracts. In a contango situation, BITI will face similar rollover costs as BTF, but these costs impact its performance differently. BITI's objective is to provide the inverse performance of the index it tracks. Thus, if the Bitcoin market is in contango, BITI's costs associated with maintaining short positions in futures contracts could result in a loss of value as well. Essentially, BITI's performance will be inversely affected by the same contango conditions that hurt BTF, potentially exacerbating its losses or reducing its gains. 2. Backwardation. Definition: backwardation occurs when futures prices are lower than the spot price. In this situation, futures contracts are priced cheaper than the current market price of the underlying commodity. Impact on BTF. When BTF operates in a backwardation market, it benefits from the lower cost of rolling futures contracts. When rolling over contracts, BTF will sell the expiring contracts at a higher price and buy the new ones at a lower price. This can result in a gain during the rollover process, as the cost of maintaining exposure is reduced. Over time, if backwardation persists, BTF can experience improved performance relative to the spot price of Bitcoin because the lower rollover costs positively impact its overall returns. Impact on BITI. For BITI, backwardation means the fund benefits similarly from the lower rollover costs, but since BITI is designed to deliver inverse performance, the gains from backwardation will be the opposite of those in BTF. Essentially, if Bitcoin's price is decreasing, a potential outcome of backwardation, BITI will benefit because it is designed to gain from declines in Bitcoin's price. Lower costs due to backwardation could enhance BITI's ability to achieve its inverse performance objective more effectively. 3. Long-term performance considerations. BTF. In a long-term environment of contango, BTF will consistently face higher rollover costs, leading to potential underperformance relative to the spot price of Bitcoin. Conversely, in a prolonged backwardation environment, BTF might outperform the spot price due to lower rollover costs, enhancing overall returns. However, the actual performance also depends on the volatility and market conditions affecting futures prices. BITI. The long-term impact of contango and backwardation on BITI is influenced by its objective to provide inverse performance. In contango, the higher costs can erode BITI's value, just as they affect BTF, but in the inverse direction. In backwardation, BITI might benefit from lower rollover costs if Bitcoin's price decreases, aligning with its goal of achieving inverse performance. 4. Volatility effects. Both ETFs are affected by the inherent volatility of Bitcoin futures markets. High volatility can lead to frequent rollovers and more significant impacts from contango or backwardation, compounding the effects on performance. BITI's inverse structure amplifies the sensitivity to these market conditions, making its long-term performance more volatile and unpredictable. In summary, contango and backwardation affect BTF and BITI in ways that reflect their investment strategies. Contango generally leads to higher costs for maintaining futures positions, impacting both BTF and BITI negatively, with BTF underperforming the spot price and BITI experiencing inverse effects. Backwardation provides a cost advantage in rolling futures contracts, potentially benefiting BTF with improved performance and BITI by aligning with its inverse strategy. Understanding these dynamics is crucial for evaluating the potential returns and risks associated with holding these ETFs over time. What are the implications of investing in an inverse ETF like BITI during periods of high market optimism, compared to investing in BTF? Investing in an inverse ETF like ProShares Short Bitcoin Strategy ETF, BITI, during periods of high market optimism presents significantly different implications compared to investing in a direct exposure ETF like the Valkyrie Bitcoin Strategy ETF, BTF. These differences stem from the fundamental nature of these ETFs and how they are designed to perform relative to the market. 1. Nature of BITI and BTF. BITI is designed to provide inverse exposure to Bitcoin's daily performance. This means that if Bitcoin's price rises on a given day, BITI is expected to decline by roughly the same percentage, and if Bitcoin's price falls, BITI should increase in value. Therefore, BITI is typically used as a hedge or for short-term speculative bets against Bitcoin's price. BTF, on the other hand, is designed to provide direct exposure to Bitcoin through futures contracts. When Bitcoin's price increases, BTF's value rises, and when Bitcoin's price decreases, BTF's value falls. BTF is intended for investors who are bullish on Bitcoin and want to gain from its price appreciation. 2. Investing in BITI during periods of high market optimism. High market optimism usually coincides with rising asset prices, driven by positive investor sentiment, strong fundamentals, or favorable market conditions. In the context of Bitcoin, high market optimism often leads to significant price increases as more investors buy into the market. Implications for BITI. Investing in BITI during such periods is inherently risky because BITI is designed to move inversely to Bitcoin's price. If Bitcoin's price is rising due to optimism, BITI's value will decline. The more pronounced the market optimism and the resulting price increase of Bitcoin, the greater the losses for BITI. This makes BITI a poor choice during sustained bullish periods, as it is likely to underperform significantly. The losses in BITI during a strong bull market can be substantial and occur quickly, making it unsuitable for long-term investment in optimistic market conditions. 3. Investing in BTF during periods of high market optimism. Implications for BTF. In contrast, BTF stands to benefit directly from high market optimism. As Bitcoin's price rises, BTF's value increases because it is designed to track the price movements of Bitcoin through futures contracts. For investors who are bullish on Bitcoin and believe in its upward trajectory during optimistic market conditions, BTF is an appropriate vehicle for capturing these gains. The positive returns from BTF can compound over time if the market continues to move upward, aligning with the goals of long-term investors who expect continued market strength. 4. Risk management considerations. For BITI, the primary risk of investing in BITI during periods of market optimism is the potential for significant and rapid losses. Since BITI is intended for short-term hedging or bearish bets, holding it while the market is rising can quickly erode an investor's capital. The compounding effects of daily losses can further exacerbate this problem, making it difficult to recover if the market continues to rise. Additionally, if an investor holds BITI in the hope of a market reversal, they are exposed to the timing risk. If the reversal does not occur soon, the accumulated losses could be severe. For BTF, while BTF benefits from rising markets, investors still face risks, including the volatility of Bitcoin and the costs associated with futures contracts, such as those arising from contango. However, during periods of high market optimism, these risks are typically outweighed by the potential for gains. Investors in BTF should still be mindful of the inherent volatility in the Bitcoin market, which can lead to sharp price swings, even during optimistic periods. 5. Strategic implications. BITI as a hedge. In periods of high market optimism, BITI might be used by investors who want to hedge against potential short-term corrections in Bitcoin's price. However, this is a high-risk strategy, as the prevailing market trend might overwhelm any short-term downturns, leading to losses in BITI. BTF for growth. BTF is more suited for growth-oriented strategies during optimistic periods. Investors who believe that Bitcoin will continue to appreciate due to strong market fundamentals or increasing adoption can use BTF to gain exposure to these potential gains. In summary, during periods of high market optimism, investing in an inverse ETF like BITI is generally counterproductive unless an investor is specifically looking to hedge or speculate on a short-term market downturn. The potential for significant losses in BITI is high if Bitcoin's price continues to rise. On the other hand, investing in BTF aligns well with the conditions of a bullish market, as it allows investors to capitalize on Bitcoin's upward momentum. Therefore, the choice between BITI and BTF during optimistic market conditions hinges on the investor's outlook. BITI is for those expecting a reversal, while BTF is for those anticipating continued growth. What are the differences in risk profiles between BITI's short strategy and BTF's long strategy? The risk profiles of the ProShares Short Bitcoin Strategy ETF, BITI, and the Valkyrie Bitcoin Strategy ETF, BTF, differ significantly due to their opposing strategies. BITI employs a short strategy, while BTF uses a long strategy. Understanding these differences is crucial for investors as they directly influence potential returns, exposure to volatility, and overall risk. 1. Nature of the strategies. BITI, short strategy. BITI is designed to provide inverse exposure to Bitcoin's daily performance, meaning it aims to move in the opposite direction of Bitcoin's price. This makes it a short strategy, where the objective is to profit from a decline in Bitcoin's value. It is typically used by investors who are bearish on Bitcoin or who want to hedge against a potential drop in Bitcoin's price. BTF, long strategy. BTF is designed to provide direct exposure to Bitcoin by tracking the performance of Bitcoin futures contracts. This long strategy is intended for investors who are bullish on Bitcoin and expect its price to increase over time. BTF's performance generally mirrors Bitcoin's price movements, rising when Bitcoin's price goes up and falling when it declines. 2. Risk of loss. BITI. The risk of loss in BITI is theoretically capped, because Bitcoin's price cannot fall below zero. However, the potential for loss is still significant, particularly if Bitcoin's price rises rapidly. Because BITI seeks to deliver inverse daily returns, any upward movement in Bitcoin's price results in an immediate decline in BITI's value. Over time, if Bitcoin enters a prolonged bull market, holding BITI can lead to substantial losses. Additionally, because of the daily reset feature of inverse ETFs, losses can compound quickly in a rising market. This makes BITI particularly risky for long-term holding during periods of Bitcoin appreciation. BTF, in contrast, BTF is exposed to the risk of Bitcoin's price declining. If Bitcoin's price falls, the value of BTF will decrease correspondingly. However, unlike BITI, BTF does not face the risk of compounding daily losses in the same way. While the potential for loss is significant, especially given Bitcoin's volatility, the losses are more straightforward. BTF loses value as Bitcoin's price drops. The risk is unlimited in theory, as Bitcoin's price could fall sharply, but the losses are linear and directly tied to Bitcoin's performance. 3. Compounding effects. BITI. The compounding effect in BITI is a crucial risk factor. BITI aims to deliver inverse returns on a daily basis, meaning it resets its exposure each day. Over time, especially during periods of high volatility, the compounding of these daily returns can lead to significant divergence from the expected inverse performance over longer periods. This can result in larger than expected losses if Bitcoin's price fluctuates frequently, even if the long-term trend is downward. Therefore, the risk profile of BITI is heavily influenced by short-term market movements and volatility, making it more unpredictable over time. BTF. BTF, being a long ETF, does not reset daily and thus does not experience the same compounding effects as BITI. Its performance over time is more straightforwardly linked to the cumulative performance of Bitcoin. However, BTF is still exposed to the inherent volatility of Bitcoin, meaning that sharp drops in Bitcoin's price can lead to significant losses. While BTF's performance might suffer from market volatility, it does not face the same compounding risk as BITI. 4. Volatility exposure. BITI. Volatility poses a unique risk to BITI. Inverse ETFs like BITI are particularly sensitive to volatility because of their daily resetting mechanism. If Bitcoin's price fluctuates wildly, the daily inverse returns can lead to unexpected and potentially severe losses. Even in a generally downward trending market, high volatility can erode BITI's value over time due to the compounding of daily returns. Therefore, BITI is not only risky due to the potential for Bitcoin's price to rise, but also because of the market's overall volatility. BTF. While BTF is also exposed to Bitcoin's volatility, the impact is more straightforward. Volatility leads to fluctuations in the ETF's value corresponding to Bitcoin's price changes. However, BTF is less susceptible to the negative effects of compounding due to its long strategy. Investors in BTF should still be aware that Bitcoin's volatility can lead to significant swings in the value of the ETF, but these swings are more directly tied to the underlying asset's movements rather than the compounding of daily returns. 5. Investment horizon and suitability. BTI is generally suited for short-term trading or hedging against expected short-term declines in Bitcoin's price. Due to the risks associated with compounding and volatility, holding BTI for an extended period is typically not advisable. Investors need to be precise in timing the market to avoid the potential pitfalls of holding an inverse ETF during periods of market optimism or high volatility. BTF is more suitable for long-term investors who are bullish on Bitcoin and believe in its potential for price appreciation over time. While still exposed to significant risks due to Bitcoin's volatility, BTF does not face the same compounding risks as BTI, making it a more straightforward option for those looking to gain exposure to Bitcoin's price movements over the long term. 6. Strategic use. BTI is often used strategically for hedging purposes or short-term speculative bets against Bitcoin. Its risk profile makes it appropriate for sophisticated investors who understand the mechanics of inverse ETFs and are prepared to monitor their investments closely. BTF is generally used by investors looking for exposure to Bitcoin without directly buying the cryptocurrency. Its risk profile aligns with those who believe in Bitcoin's long-term growth potential, despite the volatility and risks inherent in the asset. In summary, BTI's short strategy presents a high-risk profile, particularly vulnerable to rising Bitcoin prices, market volatility, and the compounding effects of daily returns. It is typically suited for short-term strategies and requires careful timing. On the other hand, BTF's long strategy, while also exposed to significant risks due to Bitcoin's volatility, is more aligned with long-term investment strategies and does not suffer from the same compounding risks, making it a more straightforward, albeit still risky, investment option for those bullish on Bitcoin. How do BTI and BTF fit into a broader cryptocurrency investment strategy, considering both are focused on Bitcoin futures but with opposite exposures? BTI and BTF offer distinct roles within a broader cryptocurrency investment strategy due to their opposite exposures to Bitcoin futures. Understanding how each fits into an overall investment approach can help investors make informed decisions based on their market outlook, risk tolerance, and investment goals. 1. Role in a cryptocurrency investment strategy. BTF, long exposure. BTF provides investors with long exposure to Bitcoin through futures contracts, meaning it is designed to track the price movements of Bitcoin. It is well suited for investors who are bullish on Bitcoin and believe in its long-term growth potential. In a broader cryptocurrency investment strategy, BTF can serve as the core holding or a significant allocation for those who want to participate in the potential upside of Bitcoin without directly holding the cryptocurrency. BTF fits well in a growth-oriented portfolio, allowing investors to benefit from price increases in Bitcoin, which is often viewed as a leading asset in the cryptocurrency space. BTI, short exposure. BTI, on the other hand, offers inverse exposure to Bitcoin, meaning it is designed to increase in value when Bitcoin's price decreases. This makes BTI a strategic tool for investors who want to hedge against Bitcoin price declines or who have a bearish outlook on Bitcoin in the short term. In a broader cryptocurrency strategy, BTI can be used to manage risk, providing a counterbalance to long positions in Bitcoin or other cryptocurrencies. It can also be utilized for tactical trading, allowing investors to profit from anticipated short-term declines in Bitcoin's price. 2. Hedging and risk management. BTI as a hedge. BTI is particularly useful for investors who hold significant long positions in Bitcoin or other cryptocurrencies and are concerned about potential short-term downturns. By including BTI in a portfolio, an investor can hedge against losses in their long positions, effectively reducing overall portfolio volatility. For example, during periods of market uncertainty or anticipated negative events affecting Bitcoin, BITI can provide a protective buffer by gaining value when Bitcoin prices fall. This hedge can be especially valuable in a highly volatile market like cryptocurrencies, where prices can swing dramatically over short periods. BTF for long-term exposure. BTF's role is more aligned with investors who are looking for long-term exposure to Bitcoin's price movements. In a broader cryptocurrency strategy, BTF can serve as a foundational investment, providing exposure to Bitcoin's potential growth. For investors with a positive long-term outlook on Bitcoin, BTF offers a way to participate in the market without the complexities of directly managing or storing Bitcoin. This can be appealing for those who prefer to gain exposure through traditional financial products rather than dealing with the technical aspects of cryptocurrency ownership. 3. Diversification within a crypto portfolio. BTF is part of a diversified crypto portfolio. In a diversified cryptocurrency portfolio, BTF can be complemented by other assets such as altcoins, blockchain-related stocks, or other crypto-focused ETFs. BTF provides the core Bitcoin exposure, which is often considered the anchor of a crypto portfolio, given Bitcoin's dominance in the market. By pairing BTF with other cryptocurrencies or crypto-related investments, an investor can diversify their exposure to different segments of the market, potentially reducing risk while still capturing the growth potential of the broader crypto space. BITI for tactical allocation. BITI can be used tactically within a diversified portfolio to take advantage of market corrections or bearish trends. For instance, if an investor believes that Bitcoin is overvalued or anticipates a market downturn, they can allocate a portion of their portfolio to BITI to hedge against these risks. This tactical allocation can provide downside protection or even profit from market declines, balancing out the risks associated with long positions in cryptocurrencies. 4. Market sentiment and timing. BTF in bullish markets. BTF is best utilized in a broader strategy when the market sentiment is bullish, and the investor expects Bitcoin's price to increase. During these periods, BTF allows investors to capitalize on the upward momentum of Bitcoin, contributing to overall portfolio growth. In the context of a broader strategy, BTF can be a key driver of returns during bull markets, especially when Bitcoin is leading the charge in the cryptocurrency market. BITI in bearish or volatile markets. BITI is particularly effective in bearish or highly volatile markets where Bitcoin's price is expected to decline. In a broader strategy, BITI can be deployed when there is significant uncertainty or when market indicators suggest a potential downturn. It allows investors to take advantage of or protect against the downside risk, making it a valuable tool for navigating bear markets or periods of heightened volatility in the crypto space. 5. Short-term versus long-term strategy. BITI for short-term strategies. BITI is generally more suited for short-term strategies due to its inverse nature and the daily resetting mechanism of inverse ETFs. It is typically not intended for long-term holding because of the potential for compounding losses in a rising market. As part of a broader strategy, BITI is best used for short-term hedges, speculative trades, or tactical adjustments based on expected market conditions. BTF for long-term holding. BTF, in contrast, aligns with long-term investment strategies. Investors who believe in the long-term growth of Bitcoin can hold BTF as a core component of their cryptocurrency allocation. Over time, as Bitcoin potentially appreciates, BTF can contribute to overall portfolio growth, making it suitable for long-term investors who are willing to ride out the market's volatility. 6. Liquidity and accessibility. Both BITI and BTF in traditional portfolios. Both ETFs provide access to Bitcoin exposure within traditional financial portfolios without the need for direct cryptocurrency holdings. This is advantageous for investors who prefer to keep their investments within regulated financial products. By including BITI and BTF in a broader strategy, investors can gain exposure to Bitcoin's price movements through their existing brokerage accounts, benefiting from the liquidity and ease of trading that ETFs offer. In conclusion, BITI and BTF play complementary but distinct roles in a broader cryptocurrency investment strategy. BTF is ideal for investors seeking long-term exposure to Bitcoin's growth, fitting into a portfolio as a core holding for bullish market scenarios. BITI, on the other hand, serves as a tactical tool for hedging or short-term speculation, providing inverse exposure to Bitcoin for those anticipating price declines. Together, these ETFs offer a comprehensive approach to managing both the opportunities and risks associated with Bitcoin, allowing investors to navigate different market conditions effectively within their broader cryptocurrency investment strategy.